So in fixed income market, investors are focused on the outbreak of the Chinese virus. The knee-jerk reaction of the market has been to bid up the price of treasuries. Yields have come down to 160. In bond space, that's the same. German yields have come down to minus 35 with some moderate widening in credit spread in the investment grade part and more substantial widening in high yield space, partly because investors had piled in onto speculative grade late in the year so that they were willing to offload some of the risk early on. In sovereign space, however, we've seen general stability of spreads, and Italy even rallied after the local election, which Salvini didn't win, and that was seen as good news in the market, so that Italian spread came in quite substantially afterwards. The virus outbreak obviously took a toll on equity markets. The rally had been fueled by liquidity at a time when earnings growth has been quite modest and continues to be modest in the fourth quarter, although we've seen some better numbers out of some consumer sectors, in particular in the United States. Still, markets have fallen quite a bit. Investors pared their bets on equities, and that's the same pretty much in Europe, where we have also indices coming back down a few percent from the highs in early January. Some investors have been coming late to the party, so that we probably have some weak hands in the market forced to sell as the market turns down due to the virus outbreak. We look for the growth theme to re-emerge in equity markets in Europe. We've seen that in flows chasing the defensive growth theme, and accordingly sectors that are deemed defensive have been doing well in the early part of the year. So the virus entails a new source of uncertainty. We believe that central banks will act on it by promoting further accommodation in the financial markets. That should provide ongoing support to risky asset market going forward.